Okay, there are certain more current affairs which we have to study. Economic capital framework is done, right? So there is one more thing, RBI integrated ombudsman scheme. So what is this RBI integrated ombudsman scheme? What happened was, before this, if you had any problem related to RBI, or sorry, if you have any problem related to bank, you have to go and approach for banking ombudsman. And if you had any problem related to NBFC, you had to go and approach for NBFC ombudsman. And if there is any problem related to digital transaction, there was also a separate digital transaction ombudsman which you have to approach. So what did RBI do in order to help Aam Aadmi, that is make the life of the man easier? They merged all the schemes into one single scheme, that is integrated ombudsman scheme. There is only one single portal where if you have to lodge any complaint related to bank, NBFCs or digital transaction, you can do it here, and it is also completely free. There is no free for filing any complaint. What all banks does integrated ombudsman scheme control? All the central banks, all the cooperative banks which are present under Banking Act of 1949, and all the commercial banks, even regional rural banks, primary urban cooperative banks, non-scheduled urban cooperative banks up to 50 crore rupees, and all the NBFCs, but except National Housing Bank. And even all the payment systems are controlled by RBI integrated ombudsman scheme. And the scheme is administered by the executive director of RBI. In before the amalgamation, it was deputy governor, and now it is the executive governor of RBI. So this is about RBI integrated ombudsman scheme. What is bad bank? So bad bank, it is nothing but it is a corporate entity, or it is a asset reconstruction company. That means if any bank has so much amount of NPAs, that is non-performing assets, bad banks tend to buy this so that the banks are free of all the NPAs and they can perform their core business of lending. So this will study bad bank in banking reforms in a detailed manner. And one more current affair here was one state, one regional rural bank. So what is one state, one regional rural bank? So under RRB Act 1976, it was a localized rural helping bank which was present at multiple levels. So government wanted a single regional rural bank for the entire state. So most states had multiple RRBs. There were different sponsor banks also. Sometimes it's SBI, sometimes it's Canara Bank, etc. Central government share is 50%. So why they wanted to do this? So that smaller RBIs often they struggle with the cost, or they struggle with adopting technologies, and whenever it is a single entity, it can be better administrated, better technology adoption are also present. But what are the challenges? So the sponsor bank, there are multiple sponsor bank. So to merge into a single bank, the three different banks, maybe SBI owned RRBs, BOB owned RRBs, how will they become a single sponsor for the merged entity? And different RRBs had different work cultures. How to make it a single state, single RRBs? But recently government is adopting the policy of one state, one regional bank. Initially, what did it do? It merged all the RRBs with the same sponsor bank, and then merged RRBs across different sponsor bank. Now it is pushing towards one state, one regional rural bank. And okay, this completes banking system in India. Okay, next is monetary policy. So what is monetary policy? Monetary policy is like the engine which helps in maintaining the amount of money which is present in the economy, which is the major function of RBI. Yeah, it helps in maintaining the size of money, that is quantity of money which is present in the economy, cost of money, that is interest rate which is present in the economy, and it is mentioned explicitly under RBI Act of 1934. once in 2 months, that is bi-monthly, RBI announces its monetary policy. So it becomes 6 times a year. The main objective of RBI monetary policy is to maintain the price stability, that is to control the inflation and to support the growth in the economy. Inflation targeting, it is done since 2016. After getting a statutory framework, it is done anchoring to headline CPI. So based on headline CPI, we target it to 4% with a tolerance band of plus or minus 2%, which is considered as a safe zone. So if inflation is staying out of this, that is with a less than 2 or more than 6, then RBI has failed for 3. If it happens for 3 consecutive quarters, then RBI must also explain to government why did this happen. What is monetary policy committee? So this is monetary policy, but this inflation targeting, how much, everything, who announces it, or who decides it? It is decided by a jury, which is nothing but the monetary policy committee, which decides the interest rates which has to be present. It has 6 members in it. 3 are from the very own RBI and 3 others are nominated by the central government of India. Who is the chairperson? RBI governor is the chairperson of monetary policy committee. Voting is done, decision is taken by majority, each individual has voting, and in case there is a tie 3-3, then the governor comes into picture. He has a casting vote. He does not have any extra vote initially, but he has a casting vote in case of a tie. So the different monetary tools which are used by RBI in order to maintain the economy size as well as cost of interest. These are clubbed into 2 types: quantitative tools as well as qualitative tools. And okay, whether these people are eligible for reappointment in monetary policy committee, that is who are nominated by the government? No, they are not re-eligible for reappointment, and they are appointed for a period of 4 years. These are the 2 things which we can add in monetary policy committee. So coming to the quantitative tools of RBI. So these are those tools which affect the entire economy. That is, they decide the amount of money, the quantity of the money which has to be present in the economy. Okay, I have to study this. If this is the boss, that is RBI, there are multiple banks, and people in the economy, and to control everything, the government. So first tool is CRR. Okay, let's study CRR and SLR here. CRR, it is nothing but it is the amount of money which the bank deposit within the RBI in terms of cash under RBI Act of 1934. That is certain percentage of their NDTL. It is currently 3%. There is no fixed minimum or maximum for this. Why they have to give this amount of money to the RBI? So that it acts as a security amount. It is kept only in the cash and it is kept within the RBI. Banks cannot held for themselves. If they did not keep the CRR, then they should even pay penalty, and RBI will not pay any interest to the banks. It is just for the security of the amount. Then what is SLR? SLR is under Banking Regulation Act. So here also banks pledge certain amount into the RBI, but here it is either in cash or in gold or in government securities, maybe T-bills, etc. And these are kept within the banks itself in a separate vault, no need of depositing in the RBI. And maximum RBI can ask for the banks is about 40%, cannot ask more than it. Currently it is around 18%, and in return RBI will also pay interest to the banks. Why is this SLR? This SLR is mainly to control the expansion of credit in the economy, ensure that there is solvency of the commercial bank. This is about CRR and SLR. One major thing here, banks will not earn interest on CRR, whereas banks earn interest in SLR. Money is deposited within themselves in SLR, and money has to be deposited in the RBI in CRR. This is under RBI Act of 1934, and SLR is under the Banking Regulation Act. So the rate at which RBI lends money to banks or even governments against collateral, that is G securities, for a short term, maybe 1 day, 7 days, or even 21 days, this rate is known as repo rate. So what happens here? If RBI increases the repo rate, so banks will not get so much money, and so much money will not be transmitted to economy, and therefore money in the economy decreases with the increase in repo rate. This is how the economy is controlled by RBI. Second thing is reverse repo rate. What is reverse repo rate? Here banks pledge their excessive money to the RBI, in turn receives government securities. So this is reverse repo rate. And next thing what we have to learn is, what if bank needs money overnight, or some emergency happens and bank needs money? At that time, what is known as marginal standing facility rate. That is, bank borrow overnight, and here also collateral is given as G security, but here they can even pledge G securities from their SLR quota. And what about if bank needs money for long term? Then it is the bank rate at which banks receives money, again by pledging G securities. So all these things has an impact on the economy. If MSF increases, money in the economy decreases. If repo rate increases, money in the economy decreases. And what about reverse repo rate? If there is too much money in the economy, government want to take it, so money from the people go to the bank, and from the bank it goes to the RBI. There is one more thing known as SDF. Okay, when banks pool their excessive money into the RBI, but here there is no collateral or no government security, it is just for the security purpose, banks pull their excess money into the RBI. And currently SDF is the new flow. SDF is the new policy rate which is being adopted by the RBI. Here SDF acts as a floor because it is a minimum rate, and MSF acts as a ceiling rate, it is highest rate. Now there is something known as OMOs. What is OMOs? Open market operations. That is, government securities are bought and sold between the RBI on behalf of government to the bank. That is operation, that is open market operation. And within the open market operation there is operation twist. What is operation twist? Operation twist is nothing but selling of all the short term securities and buying of long term securities by the RBI. Now there is one more concept known as Base and means advances. What are base and means advances? So if the central government or the state government does not have enough money with them, that they can also take loan from RBI. This is specifically for 90 days. This is given under repo rate of interest known as base and means advances. If crosses more than 90 days, then they even charge penalty of more than 2% than that of the repo rate. So this is base and means advances. So this is about the quantitative tools. So repo rate is the rate at which banks take loans from the RBI. Reverse repo is the reverse of it. What is liquidity adjustment facility? The conducting of operation of reverse repo rate and reverse repo rate is liquidity adjustment facility. Marginal funding standing facility is overnight draft facility. Bank rate is long term loans, which is usually pledged to MSF, and SDF is like reverse repo, but there is no collaterals which is to be given. Open market operation is related to buying and selling of government securities. These are things which are in news. Base and means advances are between RBI and government when there are receipts imbalances. Next thing is, this is also in news, variable rate reverse repo. Here what happens in reverse repo rate, the rate is usually fixed by the government, but in variable rate reverse repo, the RBI does not fixes the rate, but it is left to market auctioning or bidding happens, and then banks or the market determines the repo rate. And there is something called as switch auction. So what is switch auction? This is also in news. Switch auction is switch auction is, let me explain it here. Okay, switch auction is mainly between RBI and banks, or RBI or government and banks. Here RBI tend to buy loans from the banks which they have, that is G securities from the banks, which are of short term, and give them back long term loans or long term G securities. It is majorly if banks immediately have to give money, it will go bankrupt, so they will buy all the short term loans and give them long term loans. This is mainly for loan restructuring. That is switch auction, switching the short term loans into long term loans by the government. Next is quantitative tools. So what are the different quantitative tools? Here what is happening to the qualitative tools? It is controlling the amount of money which is present in the economy. In qualitative tools, it is acting upon the banks for different purposes. That is for different and specific purposes. So first thing is moral suasion. Morally requesting the banks or persuading the banks that to follow its lead. That is telling the bank, please pass the repo rate to the economy, please give credit to specific sectors. It is not a statutory obligation. It is done by the RBI as a moral work. Direct action. What is direct action? It is taking action to the government. So RBI asks bank CEO return all the money, or it will impose penalty or not doing certain things. This is direct action. That is scolding banks that you are not following rules and giving them punishment. What is credit rationing? Rationing of credit. In other words, it is regulating the purpose of loans. That is asking bank to follow priority sector lending, like give loans to farmers, give loans to renewable energies. So this is about credit rationing. Then what is consumer credit regulation. So what is consumer credit regulation? That is regulating the EMIs we pay. So regulating how much down payments has to be done with. That is about consumer credit regulation. What is fixed margin requirement? Let's study it in the form of loan to volume requirements. For example, if you are pledging a security, so how much of it can be paid to the customer? For example, pay if you're pledging a security of gold worth rupees 10,000, you won't be receiving loan of 10,000, right? You will be receiving loan of 5,000, maybe 6,000. So this is nothing but margin requirements, which is a qualitative measure which RBI tells to the banks to give so much loan only. So this is about fixed margin requirements. Next is monetary policy stance. There are different types: accommodative policy stance, neutral policy stance, or contractionary policy stance, or calibrated tightening. So there are different things. Let's study in the form of table. So how it is affecting the economy. So first thing is accommodative stance. So accommodative, also called as dovish stance. Here what is happening is growth in the economy is slow, so RBI wants people to spend or people to invest. So what it does, it will decrease the repo rate so that money is pooled into the economy. Or what it does to the CRR, it will again decrease the CRR. So what happens, money in the economy will increase and it will support growth, because growth is slow in the economy. Second is neutral stance. What happens currently, we are following neutral stance. RBI has announced neutral stance. What is happening, growth is stable, inflation is stable, everything is balanced, so rates are usually unchanged or status quo, so money in the economy is again balanced. Third stance is contractionary stance, also called as hawkish stance. What is happening here, there is high inflation in the economy, so RBI wants to suck out all the excess money which is present in the economy. What it does, it will increase the repo rate aggressively, it will increase the CRR so that it can take all the money back, it can lock away all the bank money in cash with itself. So money in the economy will decrease and liquidity will decrease, and therefore inflation will come down. And fourth one is calibrated tightening. Here what is happening, there is inflation alert, but inflation is not at present in the economy. So RBI wants to prepare the market so that rates won't fall. It will increase the repo rate steadily, but CRR will not be changed. It might increase in future. The economy should be stable or it may decrease. So this is about monetary policy stance in the economy. Limitations of monetary policy, one we have already learned, that is liquidity trap. Whatever RBI do with reverse repo rate or with CRR, what happens is it is not transmitted in the economy because people tend to keep their money within themselves, so that results in liquidity trap. So that results in ineffectiveness of monetary policy. There is also time lag between what RBI does and what bank does, and sometimes bank does not follow whatever, does not lead to transmission of the monetary policy to the economy. That is known as transmission issues. So these are some of the limitations of monetary policies. In next, types of deposit, banking sector reforms, and certain miscellaneous things, and we will be done with banking.